Today's topic is risk and rates of return. This is the outline. We will cover following topics: investment returns, expected rate of return, standalone risk, standard deviation and coefficient of variation, risk aversion and required returns, portfolio risk, diversifiable and market risk, security market line and capital asset pricing model. We have two types of investments. The investment is either good investment or bad investment. Good investment are those investment in which the return is sufficient to compensate for the perceived risk. Whereas bad investment is the investment in which the return is insufficient to compensate for the perceived risk. What is risk? A risk is a chance that some unfavorable event will occur. What is investment risk? The risk is related to the probability of earning a low or negative actual return. There are two types of risk: standalone risk and portfolio risk. Standalone risk, the risk an investor would face if he or she held only one asset. It is the risk which is associated with an investment that which is held on its own, whereas portfolio risk is that risk which is associated with an investment that which is maintained in a portfolio of investments. Following are the statistical measures of standalone risk: probability distributions, expected rate of returns, standard deviations, and coefficient of variations. Here is the probability distribution. What is a probability distribution table? Listing of possible outcome or event with a probability. Here you can see this. We have three different economic situations which affects demands: strong economy, normal economy, and weak economy. So probability of this demand occurring, that is, there's 30%, there are 30% chances that the economy would be strong, 40% chances that economy would be normal, and 30% chances that economy would be weak. Here are the rate of return on of Martin's products if this demand occurs. That is, if the economy would be strong, the rate of return would be 80%. If the economy is normal, the rate of return is normal, that is 10%. And if the economy is weak, the rate of return would be negative. Negative means that loss, 60% loss. The average, if we take weighted average, then the average expected return would be 10%. So this 10% represent the expected average return of Martin's products. Similarly, we have US water. The same expected return is 10%. So what is expected rate of return? It is the rate of return expected to be realized from an investment. It is the mean value of probability distribution of possible return. The weighted average of outcomes. Here you can see that we have three different probability, and here it is the average of all three, the weighted average, or you can see that the mean return. Here it is the mean return. How do we measure risk? As more scientific approach is to examine the stock's standard deviation of returns. Standard deviation is a measure of the dispersion of possible outcomes. The greater the standard deviation, the greater the uncertainty. Therefore, the greater the risk. Here you can compare these two companies, the Martin Products and the US Water. Here both companies' average return or expected return are same, 10% and 10%. But you can see that the dispersion is very high in Martin Products. Means the deviation from the mean is very high. From 10%, the company can make profit up to 80% or can make loss to 60%. But here you can see that the company's deviation, the rate of return deviation in US Water is less as compared to the Martin product. So you can say that it has it should have more standard deviation, so the risk is more. Here, risk is less. So this is the Martin's product standard deviation. This is the process, and here it is the formula. Summation of Ri minus R hat. R hat is basically the expected average return. Just we have learned in previous slide. This one. This is R hat. So Ri minus R hat whole square times probability. And what is coefficient of variation? It is the standardized measure of risk per unit of return. Per unit of return. Calculated as the standard deviation divided by expected return. Standard deviation divided by expected return. The calculation of coefficient of variation is useful where investments differs in risk and expected return. So we are going to solve two problems which are related to probability distribution, expected stock return, standard deviation, and coefficient of variation. In your course pack, on page number 290, we have this problem A-1. You can see that a company's stocks return have the following distribution. There are 5 different possibilities of the demand, that is weak, below average, average, above average, and the strong. Probability of this demand occurring, that if the economy is weak, it has the weak economy has 10% chances that the economy would be weak. 20% chances are that the economy would be below average, 40% chances that the economy would be average, and so on and so forth. One thing must be noted, that the sum of the probabilities must be equal to 1. It should not be less than or more than 1. Here are the rate of return if this demand occur. Means if the economy is weak, then the company get 50% loss, 5% loss if the economy is below average, 16% in case of average economy demand, average demand, 25% in case of above average demand, and if the demand is strong, the return would be 60%. So there are three things to be, 3 things are required. Expected return, number 1, standard deviation number 2, and coefficient of variation number 3. So we are going to calculate it on Excel sheet. Here's the problem, A-1. So first we are going to calculate expected return. This is the formula of expected return. The probability should be multiplied by return, Ri. This is Ri, this is P. So here we multiply Ri with P. So these are the expected returns, and if we add these returns, we get R hat. Here is the summation, 11.4. So 11.4 is the expected return. What we did, we simply multiplied P by Ri, and then we take sum of all of these demand situations. The second requirement is standard deviation. The first step would be Ri minus R hat. So we have Ri in column C, and R hat is 11.4. So we deduct R hat from Ri, and then in the next step we take square of it, means Ri minus R hat whole square. And in the last step, in the second last step, we multiply Ri minus R hat whole square with probability. So F10 multiplied by probability, that is okay. And what is the summation of it? 712. So for standard deviation, we need to calculate square root of 712.44. So in this next step, we take square root. Here's the formula of square root, this one. Okay. Square root of 712.44. So the standard deviation is 26.69, and the coefficient of variation. This is the formula of coefficient of variation. The standard deviation should be divided by expected rate of return. So here we have 26.6915 standard deviation divided by expected return. Expected return is 11.4%. So the coefficient of variation is 2.341. This represents that for 1 unit of expected return, the firm has 2.34 units of standard deviation, or in simple word you can say the risk. So that's it. The next problem is also similar. page number 291 from your course pack, 8-6. So 8-6, here it is. Now we have two different stocks X or stock Y, and these are the expected future return of X and these are for Y. We will have to calculate the same three requirements, that is expected rate of return, standard deviation, and coefficient of variation of X and Y each. The procedure is similar as we have just completed for problem 8-1. Okay, class, we are going to repeat the same procedure first for stock X. Here is the data, or these are the returns for stock X. This is X, and then we will repeat the same procedure for stock Y. So expected return RI. For expected return, we are going to multiply P into RI. So P multiplied by RI. Okay. And then we take summation. So this is your expected return. Expected return, or you can say this is your R hat. R hat is 12. The next requirement is standard deviation. So for standard deviation, we will deduct R hat from RI. Minus 12, okay. If we take amount in 2 digits, okay. So the next step is we take square of Ri minus R hat. Square. So in the next step, we simply multiply probability with Ri minus R hat square. Multiply by P. And then we take sum of it, which is 148.8. For standard deviation, this 148.8 would be used for taking standard deviation. Here we have the function of standard deviation. So square root. In the last step, we take square root of this amount. So 12.198 is your standard deviation. And the last calculation is for coefficient of variation. So coefficient of variation is standard deviation 0.198 divide by expected return, which is 12. So coefficient of variation is 1.0165. So this was for product for stock A. For stock X, here is the stock X. Okay, then we are going to repeat the same problem for Y, same procedure for stock Y. So here you can see this, we have calculated it for Y. The expected return is, or R hat is 14, standard deviation is 20.51, and coefficient of variation is 1.4. Here you can see that the return is 12%, and here return is 14%. So return is higher for stock Y as compared to stock X. So the risk should also be higher for stock Y. So here you can see that the standard deviation is 20.512, where here the standard deviation is 12.19. So higher return with higher risk, less return with less risk. This was problem 8-6. Risk in a portfolio context. There are two types of investors: risk-averse investors and risk-taker investors. So who are risk-averse? Risk-averse investors dislike risk and require higher rate of return as an inducement to buy riskier securities, whereas risk takers are those who can take high risk for high return. Some risk can be diversified away and some cannot be. So we can divide risk into two different types: market risk, which is also called systematic risk. The other risk is company unique risk, which is also called unsystematic risk. Systematic risk is non-diversifiable. This type of risk cannot be diversified away. For example, unexpected changes in the interest rates, or unexpected changes in cash flow due to tax rate changes, foreign competition, and the overall business cycles. So these risks, you cannot diversify these type of risk. You cannot reduce these type of risks. So these are called systematic risk or diversifiable, non-diversifiable risk. Other risks are unsystematic risk, and you can diversify it. This type of risk can be reduced through diversification. For example, a company's labor force goes on strike, so you can control it. A company's top management dies in a plane crash. A huge oil tank bursts and floods a company's production area. As you add stocks to your portfolio, the company's unique risk is reduced. Okay, so we have market risk, which is systematic risk, and we have unsystematic risk. Now, from portfolio point of view, what is expected return? It is again the weighted average expected return on the stocks held in the portfolio. So whatever you have in your portfolio, you just take the weighted average of these returns, that returns. So you get expected return on a portfolio. What is portfolio risk? Unlike returns, portfolio risk is not a weighted average of the standard deviation of the individual stocks. portfolio risk is usually smaller because we have different type of stocks in our portfolio, so we can diversify the risk. Beta is a measure of market risk. We have just know that market risk are systematic risk, which is a non-diversifiable risk. So beta is a non-diversifiable risk. Specifically, beta is measure of how an individual stock returns vary with market returns. It is a measure of the sensitivity of an individual stock return to changes in the market. So you can see this example. We have different type of stocks in our portfolio. Like we have shares from Microsoft, IBM, GE, and ExxonMobil. And here are the expected returns, different expected returns of different stocks. And these are the proportionate investment in each stock. So we just calculate with the help of expected return and dollar investment. We can calculate expected portfolio return. So again, we have these two problems from your course pack related to portfolio beta and portfolio required return. So A-2, an individual has 35,000 invested in a stock with a beta of 0.8 and another 40,000 invested in a stock with a beta of 1.4. So if these are the only two investment in her portfolio, what is her portfolio's beta? So class, we have two different stocks. We can say that stock A and stock B. So she invested $35,000 in stock A and 40,000 in stock B. So the total investment she has is $75,000. What is required? What is her portfolio beta? So we are going to calculate portfolio beta. So first, we should calculate weightage of these investments. Here, in stock A, she invested 35,000 and her total investment are 75,000. So the weightage is 0.4667, or you can say 46.667 of her investment is in stock A. For stock B, the weightage would be 40,000 divided by 75,000. So 0.5333. The next step is the weightage should be multiplied by the betas, respective betas. So is equal to weightage is 0.466. So by just adding these two, we get portfolio beta, and portfolio beta is 1.120. So that's it for A-2. And the last is, so for today's class, last problem is 8-7, portfolio required return. Suppose you are the money manager of a $4 million investment funds. The funds consist of 4 different stocks with the following investments and betas. You can see that we have stock A, B, C, and D. 4 lakh invested in stock A, 6 lakh in B, 1 million in C, and 2 million in D. The total investment is $4 million. Here we have different betas for different stocks. If the market required rate of return is 14% and the risk-free rate of return is 6%, what is the fund's required rate of return? So Firm's required rate of return, we are going to calculate it. Here is the Excel sheet. First, we will calculate weightage. So the formula of weightage is that the investment in stock A is 4 lakh divided by total investment available. Okay. So similarly, we are going to calculate weightage of all 4 investments. In the next step, multiply weightage by betas. So beta multiplied by weightage. Then we add all 4 betas, we get portfolio beta. 0.7625 is the portfolio beta. And for the calculation of expected return of a portfolio, here it is the formula. Expected return is equal to risk-free return, which is 6%, which is given 6%, plus market risk. Market risk is 14% minus risk-free return, which is 6%, and multiply by beta, portfolio beta, which is 0.7625. So the expected return is 12.1%. Okay, class, that's it for today's lecture. And if you have any problem, any issue, any question, you can come in the counseling hours, 8 to 10 p.m. in the morning daily. Okay, class, take care.